Picture this. You are finally doing the responsible thing. Every month, you move a little bit of cash into your savings account. It feels disciplined. You are making mature financial decisions. But then you look closely at the numbers. You have $10,000 sitting in that account, earning 0.5% in interest. After an entire year of discipline, your bank pays you exactly $50. Let's look at how two different people handle this realization. John decides to play it safe and keeps his $10,000 in that typical savings account. Alex takes his $10,000 and puts it into the stock market. Fast forward 20 years, and we can see the exact mathematical result of those two choices. John's account, growing at a typical 1%, has crept up to about $12,200. Alex's investment, matching the stock market's historical 10% return, has grown to over $67,000. They started with the exact same amount of cash. The difference is the strategy. Over the next few minutes, we are going to walk through a precise 5-step framework to transition you from a saver like John into an investor like Alex, starting with just a standard bank account and $50 a month. Building real wealth requires moving past the illusion that a standard savings account alone can secure your financial future. Step 1 starts before you even look at the stock market. You need to build a real emergency fund. That means calculating 3 to 6 months of living expenses and keeping it strictly in cash. This money stays in your savings account. The primary reason beginners lose money in the market is because a car breaks down or a medical bill arrives, and they are forced to sell their investments to get cash. An emergency fund protects your investments from the unexpected surprises of your own life. Once your shield is in place, you move to step 2, separating your money mentally into 2 distinct buckets. Bucket 1 is your safety money. This holds your emergency fund, your rent, and your grocery money. It sits in a high-yield savings account where it never fluctuates and you never expose it to risk. Bucket 2 is your growth money. Because your daily survival is already protected by the first bucket, this cash is allowed to move up and down. Its sole job is to grow over the long term. With your rent and grocery money secured in the vault, the fluctuations in your growth bucket lose their emotional power. You are less likely to panic sell when you know your immediate survival is already paid for. With your safety bucket full, you are ready for step 3, opening a starter brokerage account and setting up an automated monthly deposit of just $50. This initial $50 builds the mechanical habit of automated investing. Starting small allows the system to run in the background of your life, proving the process works before you commit larger sums. As that money hits your brokerage account, you reach step 4, choosing your investment. Beginners often lose momentum here by trying to learn complex strategies like day trading or options. You need to ignore all of that. Instead, we look to legendary investor Warren Buffett. His foundational advice for everyday investors is simple. Do not try to pick a single winning stock. Buy the entire stock market at once. The easiest way to execute that advice is by selecting a low-cost S&P 500 index fund. When you purchase a share of an index fund, your single $50 deposit is instantly divided up and invested across 500 of the largest companies in the United States all at once. By doing this, you diversify your money, lower your risk, and guarantee that your portfolio captures the broad growth of the overall economy. This removes the stress of guessing which individual business might fail. Now you have an automated investment system running. Step 5 is mastering the psychology to keep it running. To do that, we use the seed analogy. Sticking purely to a savings account is like storing seeds inside a sterile glass jar. You are protecting them, but they will never sprout. Investing is taking those same seeds and planting them in the dirt. At first, it looks messy, and you don't see results immediately. But over time, they erupt and grow into a massive tree. The reason most people refuse to take their money out of the jar is the dirt. They are afraid of the short-term mess. In the stock market, that mess is volatility. The fear that on a random Tuesday, the value of your account might drop. This chart shows what terrifies savers. The line plunges downward. Your money feels like it's evaporating. But your emergency fund protects you, so you don't panic. Your automated transfer continues. And because the market is down, your money buys more s'mores at a massive discount. It is time to put this into practice. Start step 1 today. Calculate what 3 months of living expenses looks like for you. Write that number down and set up your first $50 automated transfer.